space. But Manish Sonthalia joining us, Director and Chief Investment Officer, MK Investment Managers. A good time, if at all there is any, to get him on board and get a view from Manish, because he understands macro, he understands markets, and he understands India ever so well. Manish, great having you. What should one do? It's a very tricky environment, Manish. Very good morning to you. Very tricky environment. What should one do?
So I think, the directional view is that the conflict will widen first, then it will shift into a longer phase of economic compression, forced adjustment, and selective repair rather than a broad-based recovery. I think the solution which we, and obviously the markets are looking at, is not a diplomatic sort of a situation, settlement. It is more likely a military sort of a settlement. So it's no longer just a geopolitical event. I think it is manifesting itself in, high increased oil prices, LNG and freight. It is now an inflation adjustment event. Supply chain dynamics have got disrupted, and the growth shock is moving through the global economy. So as far as India is concerned, we should be looking at a selective repair. And I think whenever this war ends, 2 weeks or 3 weeks, it's going to take a lot of time for repair to happen, particularly to economies which are dependent on oil. And India is obviously one of the countries which is heavily dependent on oil. And if we are in through an inflationary shock, which trickles down into the system, then obviously consumption suffers, and government has to increase fiscal deficit and all of that. This is going to take at least till the first quarter of FY27. So basically the whole of FY27 likely is getting washed out in terms of pricing in the negatives, and markets will look forward to FY28. This is how I believe this whole thing is likely to play out, because there's significant damage to energy infrastructure, the Strait of Hormuz, where 40% of global oil supplies move. I mean, that's a vulnerable point, and obviously India is going to feel the pain of it also, as through other parts of the world. But economies which are dependent on commodities, because inflation is now too set on the entire globe, and countries which have a leverage on commodities, they are likely to do better rather than consumer of commodities. So I think this is how likely it's going to play out.
Manish, I just want to give you that bad news that we're already at 21,000 thereabouts. We've dipped that 22,000 mark, and we just bring up the Nifty intraday graph. And I think it just happened where we are pretty much at the day's lows, and we're worsening from that gap down that we started off with. The Nifty futures now at 22,335. 22,190 is where we're currently at. So just less than 200 points away from even breaching 22,000. But Manish, I mean, should one be buying right now, or is it like, catching a falling knife? Should one wait for the dust to settle down? Because valuation-wise, one would say that, we're getting to the buy zone already.
No, so absolutely correct. The perspective of a foreign investor invested in India, investing in India, vis-a-vis your domestic investor who is investing in rupees is very different. So just to put things in perspective, the CAGR of the Indian economy, the GDP growth in the last 12 years, that is 2012-13, Indian economy in dollar terms was 1.8 trillion. And in 26, this is around $3.57 trillion. So basically, for a foreign investor, the economic growth or GDP growth in nominal terms in India has been around 6%. And for a rupee investor, this nominal GDP growth in India has been around 10%. So, obviously the hierarchy is being played by the depreciation of the Indian rupee, and obviously the reporting currencies of foreigners are the US dollar or equivalents, and that is why they find it very unlucrative for investments in India. Keeping that aside, I think if you're a rupee investor, things have corrected massively. And I think today we are looking at valuations which were closer to around the COVID era. And in that backdrop, we all know how things play out. So it's very difficult to forecast the next 15 days because things are all over the place globally, and repercussions are going to get felt across the industry. But think a slightly longer term. India has been resilient. Yeah, we have seen that we are a domestic-facing economy, and government comes in and expands deficit whenever the need of the hour is, and all of that will be supportive of growth. And in terms of 9 to 10%, because inflation is coming in on 9 to 10% GDP growth for India is good. And within that backdrop, some of the sectors and some of the companies where valuations have become mouth-watering from a 3 to 4 year perspective, one should actually be looking to buy. I'm not a seller at all, even though the FIs have been selling left, right, and center, and there's no hope that they would come in anytime soon. Domestic savings is replacing foreign savings, and that is basically how it's going to play out. So one needs to do one's homework, look at stocks and sectors where there is resilience, look at valuations, and then build your portfolio.
But that's the problem, Manish, because, while you know that the valuations are close to COVID levels right now, you're not really seeing that visibility anywhere. And now banks and financials, they as well, the back has been broken. And then you have these incidents like HDFC Bank, where there is then that trust deficit also comes in. And the highest weighted sector as well is getting collapsed right now. What's your preferred list in the market to buy?
So inflation is on us. Sectors which are exposed to inflation and benefit out of inflation are going to be outperformers, commodities, or you can look at, consumption where there's ample pricing power, sectors which are dependent on government orders like defense, etc., where valuations have corrected. Now that energy prices are very high, there's a renewed focus on renewables. Of course, out there again, valuations have corrected, and not to do so much with the generation part of solar renewables, but more to do with the transmission and the value chain, the transformers and the oils and all of that go into the power value chain. Those things look good. I think these hospitals where there's absolute demand inelasticity, so to speak, these are some of the places to hide. As far as the financials are concerned, of course, the large private sector banks have huge exposure in terms of FI investments. Now, with the damage that is on us because of the war, two moving variables in the banking and financial space. One is your deposit accretion. That is one. Of course, we are not talking about Q4 numbers. We are talking about FY27 going into FY28. And the second is obviously credit cost. There's already some murmurs around the fact that government may be looking at a moratorium for small businesses, like the time we saw in COVID. All of that will have repercussions for the financial space. But having said that, I think valuations are pretty okay if you were to take slightly longer term. These are self-adjusting, the credit cost, etc., gets into the P&L over a period of time. And it's a very large sector. So selectively buying, if you are looking at specifically Q4 numbers, then obviously private sector is going to report around 7 to 8% sort of a profit growth, net profit growth. Because of bond losses for PSU Bank, this profit growth is likely to be around 3%, but valuations are just the reverse. The valuations are much more favorable for PSU banks as opposed to private sector. But yes, there is a pick and choose in that. There is correction across the board.
And Manish, I'm curious to know, it's a fast-moving and a very volatile geopolitical environment, and the impact on India is also likely to be substantial if at least there is one part of the market which feels that if at all this war were to prolong for maybe another couple of weeks. Give us your take. How quickly does this war need to resolve itself for no earnings downgrades on India? And even if it were to happen, what would the earnings downgrades likely look like? Will it be short term? Will it be something more medium term? What's the sense?
The situation is evolving, and as I alluded to the fact that the damage is already on us. It's not just a military event. It is an inflation-driven supply shock event. and the growth shock is going to move across the global economy in which India is not going to be left out. So yes, India has been resilient in the past as well, but there will be some time lapse when the growth is likely to come back. So I think markets over a period of time will look at FY28 numbers now, because FY27 is a one-off normalization. If we were to build in, I mean, the war is not yet ended, but if it was to get extended, then obviously it is going to be through increased working capital. It is going to mean higher rates. It is because of inflation, and it is also going to mean compression in margins because of raw material. Second order impact is demand compression, consumption, getting more squeezed towards staples as opposed to discretionary, because there's likely to be postponement in that, and in that which is likely to be more preferred given the requirements is likely to play out, and whether the pricing power exists within the consumption spaces as well. So this is how likely the entire thing is going to play out. But I would reckon FY27, if we were previously working with 14 to 15%, at least a 2 to 3% damage to overall EPS estimates of FY27 is likely part of the course, given where we are currently.
Manish, also, the learning from the previous fiscal, given that so much transpired and it sort of, the index alone tested your patience for quite some time. What are the sectors or themes that you would steer clear of right now as you build the portfolio for the next year?
So basically, all the sectors and themes have become, mouth-watering in terms of valuations, but, supply chain bottlenecks, these are some of the spaces to likely steer away. There where you have, you have lock-in on working capital for higher periods. I think the idea is not to depend so much on export-oriented sectors currently, merchandise exports particularly, and focus more on what is produced and consumed within the country. These are areas where one needs to focus on. Some of the areas which are high ticket items, because mass income is likely to get compressed. Inflation is going to eat into your savings, real estate. These are high ticket items. They can always be postponed, so on and so forth. These are some of the spaces which one needs to be wary of currently, because these are sectors for the good times. When there's ample liquidity, when interest rates are very benign and low, and there is a lot of liquidity into the system. These are the spaces which flourish in those periods. But currently, we are not in that sort of a situation. You should likely be better off not owning them for the immediate near term. Of course, if you were to look at valuation, some of the real estate names also have corrected massively. So if you were to take 5 to 7 again, these are very good spaces to be in, but it all depends on the time horizon. Near term, obviously, they are headwind.
Manish, if I were to pull, and the typical retail investor would want to have maybe a 3-year to 5-year time horizon, very focused questions. One, is this a very good time to buy, given the fact that there is a risk to earnings over the next couple of years, which you've spoken about? And point number 2, if so, what are the best pockets?
No, so retail investor, 3 to 5 years probably, would be much better off buying at these mouth-watering valuations. We have seen time and again then that whenever it feels like the world is going to come to an end, that is the point in time when you get the best prices in the market, no matter what the naysayers would be saying. And today we are in those sort of a situation, in the current times. COVID was the last time when we saw these sort of valuations. Of course, we have seen the resilience of India time and again. So from a 3-2-year perspective for a UHNI retail investor, it's a great time to buy. It's not the time to park your money in FDs. You should go all out and buy, provided your time horizon is 3 to 5 years. Second is, you should look at the earnings power of companies and valuations. Obviously, these are the two major important things, because we are today in an extraordinary situation. This is not a normalized situation. And the earnings power should come into the question, where you have to analyze the competitive advantages of companies and how the things will come back once normalization happens. So in good times, strong companies defend their margins very well, even though volume collapses. And in bad times they defend their margins, and in good times they defend their growth. So currently, since we are in for tough times, we should look out for strong margin retention in companies. Companies which have a good visibility from the next 3 to 4 years. So defense, commodities, these are likely to, and valuations are not very demanding across the space. So I think a mix of consumption, savings, investments is part of the course, but keep it very focused on good valuations. Extraordinary valuations, extraordinary companies bought at insane prices also would not make money. So that's how we should build it.
Right. Well, time to buy the fear. That's the message coming in from Manish Sonthalia. But of course, don't blindly get into it. Do your research, see where the growth visibility as well is. Manish, so great having you today on the show. Thank you so much for your time. Okay, on that note, let's wind it up right here on this edition of The Market. Thanks so much for watching.
Welcome back. Quick take with regard to how markets are faring. 22,200 currently being held somehow, frankly, on the Nifty. But the breadth is extremely weak. We've just got about 2 advances on the Nifty 50 index, about 10 advances on the Nifty 500. What we're seeing, even in terms of contributors, we're seeing some of the heavyweights really packing a punch. RIL is down, HDFC Bank is down, L&T is down, SBI is down. Just some of the big losers and some of the big contributors on the index. But it's just the breadth which is negative. In terms of sectors as well, across the board, we're seeing red. The Nifty IT is the one which is standing out in some form or shape. 0.4% higher on the Nifty IT. But outside of that, it's a sea of red across the board. 3.5% lower on the pharma index, the PSU banking index, the realty index. There's also 3% lower on the metal index. Oil and gas also seeing pressure. But with that, it's a goodbye on this edition of First Trades. More action to follow. Stay with us.
Hello and welcome. You're tuned into Midcap Masala right here on ET Now. I'm Shriti Sharma and with me as always is Snehi Shah. And viewers, this is the show where we take you through all that is happening within the mid-cap end of the market. And along with that, we also talk to the key management. So let's get started. And firstly, let's have a look at the key headlines we are tracking at this hour. First up is V-Mart Retail that is soaring in trade after reporting a strong
Latent View Analytics Corporation, a wholly owned subsidiary of Latent View Analytics Limited, has finalized a strategic investment of $3 million in Healthian AI Inc. This transaction is a key move for the company retail. Akash, good morning and thanks for your time today. Overall, decent set of updates coming in from your end. I only wanted to get some better clarity on the SSSG number, which is coming at 7.7% this time around, which, yes, if you compare it to quarter three, that 2% number that we saw in quarter three is a sharp uptick. But if I take the adjusted or that normalized number that you had reported in quarter three of around 12.8%, this is significantly lower than that. Talk to us about how the SSSG has shaped up this time around and what have been some factors at play.
Sure. Hi, good morning. So January usually is end of season sale for us because we put a huge discounts on winter products. But this year we did much lesser discounting. That is why it had a slight impact on the SSSG in terms of sales. But when you look at GP per square feet, then we're doing much better. So if you look at this quarter in isolation, you would see a skewed number because of less discounting in winter. But if you look at the whole year, SSSG, we have almost done 9%, which is on track with our guidance of 8 to 10%. And our revenue growth was almost 61% for the whole year, which was much better than our guidance of 50% revenue growth.
So point taken over there, Akash, and I just want to talk about the FY26 guidance also. Your guidance was 8 to 10%. You have achieved that number at 8.6 thereabouts. Talk to us about what lies in store for FY27. Are you looking at reaching the upper band of this guidance, or are you looking at hiking this guidance overall?
So I think we are sticking to our old guidance for FY27. We should do at least a 50% revenue growth on top of the 61% that we did this year. And we should close the year at around 500 stores. So we opened 136 stores this year, and we will open another 150 to 175 stores this year, continuing the good momentum that we have.
All right. That's about the store opening. Hi, Akash. Morning, this is Shrishti also joining in. But give us some sense that which geographies will you be targeting in order to open the new stores?
So we take this decision according to data, and we have stores in almost 25 states now, and we have opened 136 stores. So new data will be coming in every month. So about 60% of the stores will open in core geographies where we are already very strong in. But the other 40%, the decision will be made according to the performance in different states. For example, Karnataka and the South has been very good for us. So we opened almost, I think, 13 new stores in Karnataka. So similarly, all the new states, I think we entered 8 new states this year. So whatever state gives us better numbers, we will focus on opening more stores there.
Okay, so that sounds good. Let's talk about the revenue guidance. You've been consistently growing at a very high percentage move on a year-on-year basis in all the quarters of FY26. You've seen about 50 to 60% growth in your revenues and sometimes slightly more as well. Talk to us about what happens in FY27 as your base increases. What is going to be the quantum of revenue growth that you're targeting?
So like I mentioned, the revenue growth we're targeting is around 50%. Around 8 to 10% will come from the SSSG from existing stores, and about 40% will come from inorganic growth, which will be from the addition of new stores.
All right. But Akash, also give us some sense that of late, there's a lot that's been happening with respect to the raw material cost. I'm sure that what all you must be sourcing will be the final products. But give us some sense that has there been any uptick in terms of your costing of the purchase, especially in the last 1 month?
So we haven't felt the impact yet, but definitely the yarn prices have gone up, packaging material prices have gone up. So there will be an impact in the near future. So I would say the average cost would increase by 2 to 3%, which includes packaging, transportation, fabric, cost of making. So, but that will be throughout the board and for every other retailer as well.
But 2 to 4% in the coming month or in the coming quarter is your estimate?
In the coming quarter.
All right. But Akash, we believe that along with that, do you believe that it can actually impact the demand in any way, or do you believe that 2 to 4% will be just marginal to absorb by the consumers?
I think our demand is pretty inelastic because we think the price point that we're selling at, it's basically a necessity. And we do almost 25% kids wear. So in kids wear also, the demand is pretty inelastic. And just 2 to 3% cost increase should not have a significant impact in demand. We should be able to, sustain the demand that we've been seeing.
Okay, so that sounds optimistic going ahead. And what does this, Akash, what does this do to your average selling price? Any visibility over there? Last time we interacted, you told me that you're not actively looking at increasing that metric, but what's the outlook over there?
Yeah, but this is a different situation. So there is supply side pressures. So whatever impact it has, we can't absorb everything in our margins. So there might be a 3 to 4% price hike as well.
All right, and we watch out for that. But so good having you on the channel today, Akash. Thank you so much for your time and great chatting with you.
Thank you.
All right, so that was the management of V2 Retail. Yes, of course, very strong performance and quite optimistic in the times going ahead as well. But with this, viewers, it's now time to slip into a very short break. Don't go anywhere, lots more lined up on the other side.
Welcome back to Midcap Masala. We've just interacted with the management of V2 Retail on their growth outlook and more importantly, the Q4 business update that they've released. We're on to some more news and updates in BLS International. That stock is in focus today on the back of the management's plans to invest 2,500 crore rupees for expansion into newer geographies. So what is this expansion going to look like? What are the geographies they are targeting? Basically, what are the growth plans and timelines for the same? Let's understand all of that from the management themselves. We have Mr. Shikhar Agarwal, the Joint Managing Director of BLS International Services Limited and Chairman of BLS E-Services Limited, joining us on the show. Good afternoon and thank you so much for your time, Mr. Agarwal. First, let's start by talking about the latest update that the company has provided. This 2,500 crore rupees that you're looking to invest to expand into newer geographies and newer markets. Talk to us about what is the plan here, what are you aiming for, and what's going to be the timeline for the same?
Yeah, hi. So as you know, we have announced that, we in the past also, if you see, we have done acquisitions worth 1,500 to 2,000 crores. And now, in the next 4 years, our plan is to spend this money. First of all, in acquisition opportunities, we want to spend the money on enhancing our technological infrastructure and to diversify and get into new markets. So we will be utilizing, mix of this money for different aspects.
Absolutely. Hi, good morning, Mr. Agarwal. But can you elaborate a bit more in terms of the plans are there? 2,500 crores is what you are planning to invest, but in which segments and which geographies, which opportunities you are looking at?
So definitely, in both, we are actually looking at investing in both organic and inorganic growth of the company. From organic, we're thinking of investing around 400 to 500 crores in opening our territory into newer markets, in enhancing our technological infrastructure, and on M&A opportunities upwards of 2,000 odd crores that we're looking at. We are looking at companies which are in the visa counselor domain, and also in related citizen service domain. So our plan is to invest the money over the next 4 years. If you see, our target for growth is that we want to double our revenue in the next 5 years for the company.
So from what I understand, Mr. Agarwal, you have a quite robust a set of plans for the next phase of the company, but also talk to us about how this 2,500 crore of expansion is going to be funded. Is it going to be via internal accruals? Are you looking at any sort of fundraising for the same?
See, definitely, if you see our Q3 numbers, we did around 736 crores of revenue and around 170 crores of profit after tax, which was a 33% growth, from compared to last year. So we are a negative working capital company, cash throwing company. So definitely our objective is to, fund the growth through internal accruals of the company. Also, if the opportunity size is big enough, then we might use a mix of debt plus equity, since our balance sheet is quite healthy.
All right, mostly from internal accruals. That's great to hear. But along with that, Mr. Agrawal, I'm sure you must have worked on all the models. You have the money, you have all the plans to deploy that. But what about the revenue expectation? I'm sure that, and I believe that by 2030, that's a long period. But since you must be having a timeline, can you help us with the revenue visibility from these investments, maybe in the next 2 to 3 years?
See, we are targeting as a company to grow at least at 20 to 25% over the next few years on an organic basis. So definitely we are actively bidding for various opportunities, across the world. There is a lot of market which is getting outsourced for the first time. So definitely growth could be further, but we are targeting at least a 20 to 25% growth over the next few years.
Right. And Mr. Agrawal, out of that, what will be the contribution from the international segment or your international operations? Because as we understand the escalations in the Middle East right now, talk to us if that has hampered any of your growth plans or impacted any of the plans on the international front.
See, we've been, since the time of our inception, 2007, 2008, we have been operating in multiple geographies across the world. So there are, some events happening every year in certain part of the world. But barring COVID, wherein the volume became almost negligible, we have not seen any major impact on an annual basis. Our growth happens. So there is some disruption in some part of the world for a few weeks. But as of now, all our offices are currently operating with volumes. They are poised to come back to normal from certain geographies.
All right. Yes, of course, a lot of disruption out there. Maybe next time we would like to talk a bit more on that. But for now, Mr. Agrawal, 2,500 crores announcement is indeed a big one. And add to that, in your business, I believe AI must be impacting as well. Give us some sense that how are you utilizing or reaping the benefits of AI? What sort of an impact it is already having to your cost structure, maybe helping to improve the efficiency?
So definitely AI has helped us to increase our efficiency. It has led to reduction in cost. Right now, we've invested in AI, system in our call centers. A lot of our calls are being picked up by AI agents. We have also introduced AI when we are hiring in a hiring process. A lot of level of checks are done by AI, and security features, cyber security that we've implemented across the world on our IT softwares. Definitely, we are using AI, real-time AI, to identify bots, etc., and mitigate the impact. So definitely, AI is helping us increase the efficiency, increase our bandwidth, get more volume, and at the same time reduce the cost. So definitely, I feel that we are becoming an AI-ready organization.
Okay, so that sounds good. On that note, Mr. Agrawal, we'll let you go. Good to hear about your expansion plans, the investment timeline, and of course, the fact that most of it is going to be funded from internal accruals. All of that sounding really positive. Thanks so much for your time today.
Thank you.
Okay, viewers, on that note, it's a wrap on this edition of Midcap Masala. Before we go, just taking a look at what the market is doing right now, the kind of fall that we've seen on the market since the get-go has not been arrested. We're still 2% lower, and it's a 450-point cut coming in on the Nifty. 22,222, 5 times 2 is where we are at on the Nifty right now. But yes, it's a 450-point cut as we speak. But on that note, we're completely timed out. So thanks so much for tuning in. But stay on, because buy now, sell now takes all the action ahead.